And the call has been made to international investors. The president of Ghana wants to bring in the chiefs of foreign investors, and he's been making some big calls far away in Japan, telling investors, trying to woo them and saying that, look, this is the best country to actually invest in. Why? Because he spoke about so many economic indicators that have improved. And according to him, if you look at the minimum capital requirements that you need as a foreign investor to come into the local space, certain things would have to take place. And this is what he's saying. He says those minimum requirements will have to go away. What is he talking about? In fact, if you look at the GIPC Act that brings in foreign investors supposed to do some form of promotion, there is some form of limitation in terms of foreign investors trying to come into the local space to participate, to compete, and to do business. The president says that those minimum capital requirement needs to go away. And according to him, well, if you have $10,000, if you have $50,000, you can come into Ghana and do business, because he says that we currently have the best performing currency globally. And if you look at the credit ratings agencies, their ratings so far, we've seen upgrades since the beginning of the year. Inflation is currently at 12 point, below 13% currently. And the hope is that by the end of the year, we should hit single digits. And the cause that, if you look at the Gold Board initiative, for instance, it gives the city some form of long-term respite against the US dollar. So the president says that at the back of these improved economic indicators, I am making a big call for you to come into the local space, compete, and to do business. Why? Because there will be no minimum capital requirement. He says the law is being revised to take away those requirements. But what are the requirements that we are talking about currently? If you look at the three requirements, in fact, if you are a foreign investor trying to do business in Ghana, if you are coming in to do some form of joint venture, simply means that as a foreigner, if you find the local a citizen who is able to partner with you to do business, you, the foreigner, needs about $200,000 US to be able to come into the space. And if you want to come in alone and start a venture or an enterprise, how much do you need? You need $500,000 US as the minimum capital requirement. And if we are talking about trading enterprises here, how much do you need? You need $1 million US to actually come into this space. And the reason why this was important is that it was supposed to protect, locals who were in the business, and to give them some form of, competition ability to actually compete against foreign investors. You don't want to wake up one day and find almost every corner of your economy being dominated by foreigners. And that's why it was important to put these three solid requirements in terms of minimum capital requirement. But the president says that, especially if you look at the first two, they must actually go, because you need more people to come into the space. And businesses have been reacting, not so happy. We've had a cocktail of reactions so far since the president made that call far away in Japan. But what do we know so far in terms of the revision of this GIPC law in terms of minimum capital requirement? This is not the first time that we are trying to do something like this. It started somewhere 2023. Plans were underway to especially consider the first two requirements, the 200,000 and the 500,000. That was the first requirement that we're trying to possibly revise somewhere 2023. We're almost through with that until the change of government came in 2024. So this is not the first time that a government is trying to put aside some form of requirement for more foreign investors to come in. But the question is, why do we need foreign investors to come in so far? Because already, if you look at the existing law, there are three areas that are set aside that you don't need minimum capital requirement to actually come in. If you look at the portfolio investment, if you want to come and buy bonds or any of the government securities, you possibly don't need a minimum capital requirement before you can come in. If you're talking about export trading, especially if you look at the 24-hour economy, which has an export acceleration development plan also in there. You definitely, the law doesn't require that you need a minimum capital requirement for export trading. Manufacturing, you don't need this. These are the areas that we possibly struggle the most, and so you need foreign partnership and foreign investment. That's why you have these areas not having any form of minimum capital requirement. But when it comes to the retail side and the enterprise side, where it is difficult, it's easy for anybody to walk in and do business, we needed to put some form of requirement there to shield local firms, individuals, and businesses. But it looks like the president wants more people to come into the space. Why? Because let's look at the foreign capital requirements, scrapping the foreign capital requirement. Why is this important? The reason is that the locals who are currently complaining, they fear foreign dominance in the local economy. We also saw what happened in 2022 when the economy took a nosedive and there was some massive repatriation in that period. We also saw the massive impact on the local currency. Local businesses will be at risk. Those are some of the reactions so far that we are seeing. They say maintain capital requirements, especially for key sectors. If you want to do this, just like I showed you in that slide where there are 3 areas that are currently set aside without any form of requirement, you need those ones. But in fact, when you're talking about coming into the space to do retail and other businesses, you need to keep some form of requirement. And they say that, well, you can decide to talk about revision, but you should maintain the side of joint venture. You should be able to, allow foreign investors to hold local hands and say that local participation, be able to, in a joint form companies and then also compete. But if you decide to go away or to do away with that aspect of the requirement, then you are not going to get the foreign companies coming in to help the locals. So if you're looking at the complaints we received so far, the reactions in terms of those who are opposing, these are the reasons that they are currently tabling, especially the fact that you may end up having foreign companies dominating the Ghanaian economy. But so far, looking at the Ghana Investment Promotion Center, what do we know so far in terms of the projects, the foreign investors who have come in to register projects and are currently doing them? We did a counting, and how many did we find? Over 270,000 projects so far, with at least an investment package of 30.2 billion Ghana cedis. So you see, 2,705 projects so far, with a total investment package of over $30 billion, all coming into the economy. But if you look at it this way, you may say, oh, this is fascinating. We need more investors. But let's go into the numbers and you understand why this may not have any form of impact, possibly significantly on the Ghanaian economy. Just look at the investment so far over the years. And we're tracking this from 2012 to 2024. And what you can see is that although we have over 2,750 projects from foreign investors, if you're looking at it on the tangent of foreign direct investment, we've not been doing so well since the highs of 2012, where we were recording foreign investors of almost $5 billion in a certain fiscal year. Now we've moved from that close to $5 billion. Now we're talking about some $617 million so far. So you see how we've come down in terms of foreign direct investment. This is an area of concern because if you are registering more projects, it should reflect here, especially looking at the fact that there are some certain areas that have been set aside. You don't need any form of capital requirement to come into that space. But when we look at it based on this trajectory or based on this curve, what you realize is that foreign direct investment has not been something that we can actually write home about. We've seen a nosedive since 2012. Now let's count the project. That over 2,000 projects we saw. Look at it on this, from this side or from this perspective. Look at it from 2024 and compare it to the highs of 2013 and 2012. What you see is that we do not have more foreigners coming in at the moment because 2024 we registered only about 140 projects. Could this be the reason why the president is saying that, well, I have looked at this data, and I have seen how we are coming down from the highs of the 400s and the 300s, now just talking about 140. Why don't we take away the minimum capital requirement? Because maybe that could be the reason why, or the stumbling block, the reason why investors are not coming into our economy. Because something needs to give. I mean, we can't be coming down from 400 to 140. So the question is the president basing his decision based on this data that he has actually seen, where we've seen the number of projects coming from the GIPC side, coming down significantly to 140. But you may look at it on this tangent. But in terms of the target so far, the foreigners or foreign investors, when they come in, which areas are they targeting so far? Manufacturing, the services sector. And these are, I mean, if you look at manufacturing, this is an area that we don't have any form of minimum capital requirement currently. So why do you need to take away the requirements? The services sector, which is actually booming and driving the economy, plus the agri sector, is also one area that when foreign investors come into the country, they currently look at. But where are they coming from in terms of those foreigners? They come from China, there's some coming from India, there's some coming from the Britain. US is also involved, and there is Lebanon. So you see, in terms of the top 5, this is where our foreign investors are coming from. Those who are actually interested in the Ghanaian economy come from this side. And so it's not surprising that you see the president making the call in Japan. Japan is not so far away from China, right? So you see almost about 3 of them or 2 of them coming from Asia. One, US, US is coming in. There's also Britain in the Eurozone, definitely in Europe. And then also you have Lebanon also in the picture. So you see the distribution, and definitely you know that the top 2 are coming from Asia. And that's why the president is in Japan making this big calls and saying that we are bringing in the chiefs of investors coming. And we are talking about the president calling investors to come in so far. And based on that big and beautiful picture he painted about the economic indicators, that inflation is coming down, the exchange rate situation has improved. We still have big companies who are multinationals also leaving the space. Glovo has left, Nivea has left, Jumia Foods has left, Dark and Lovely is no more, and Game has also left. And we've seen others also trying to also leave the country. So the question is, if the economy has really improved and many are currently expected to come in, why do you have all of these giants leaving the space? But many will say that they left in a certain period when the economy was not so good. Things have improved. And I showed you the data where inflation is now around below 13% currently. Exchange rate situation, the cedi has appreciated more than 40% against the dollar since the beginning of the year. The president says that if you look at these amazing economic indicators, it makes Ghana the best destination to invest. And the reason why he wants the minimum capital requirement to leave. After this short break, my guest and I will be going deep into these issues, try and find answers to the questions raised so far. Are local firms at risk to scrap or not to scrap? That will be the point of focus when we return from this short break. Thank you very much for joining us here on PM Express. And PM Express, as you always know, is brought to you by Synthes Tank, a strong, a tough, Pepsodent cavity fighter, and Academic Times. My guests have joined me for an interesting conversation on whether to scrap or not to scrap the minimum capital requirement for foreign investors. And that's what we are going to focus our discussion on. Joseph Obeng is the president, Ghana Union of Traders Association. He is with us in the studio. Professor Patrick Esumin is an economist, University of Ghana Business School. He will join us via Zoom. And Apia Kusi Adomako is director, West African Regional Center for CAT International. He is in the studio with us. And Eric Defo is the chairman of Economic Affairs Committee, Association of Ghana Industries. He will also join us. And Frederick Emisa is technical advisor to the Minister for Finance. So, gentlemen, you're welcome to PM Express.
Thank you.
Thank you.
I don't know where you want to start the conversation from, but it's always good to bring in government first since they have been making this score. So I'll start with Frederick. Frederick, you have been listening to the president. Far away in Japan, he's been making big calls to international investors. He's been referencing the good gains of the economy so far, and to him, there must be some form of revision to the GIPC Act, and he says that those minimum capital requirements should go. Help us understand how you came to this conclusion, why you want to go on this trajectory.
To you and your listeners. I think we should look at it in the light of the broader efforts by government to improve the business environment or the business-friendly environment of the country, of the economy. You know, since we came to power, we have tried as much as possible to stabilize the macroeconomic environment. We've gradually been able to bring producer price inflation down. Headline inflation, as in consumer inflation, is also down. And we've seen generally interest rates are trending downwards. So it has to be seen in the light of the broader conversation around improving the business environment of the country. So like I mentioned, it shouldn't be seen in isolation. We're trying to kickstart the economy, trying as much as possible to get all cylinders of the economy firing. And government believes that it is also important to have a look at the foreign investment climate or foreign direct investment climate of the economy to see how best we can jig it up. The data you showed, the data you projected showed that obviously, since the time we passed this amendment, since the time we passed this new GIPC Act from 2013, we've seen both in value and in the number of projects, FDI decreasing. So it's about time we just took a stop and look and analyze and see that what can we do. You see, it's also important that we look at what FDI does for an economy. FDI is not just about money or investments, which is coming into the economy. It's also talking about technology. It talks about new skills. It talks about new knowledge. It talks about so many other things. It's also new supply chains which will be established because we allowed one extra investor to come into the economy. And let's be frank. Some will say, oh, then somebody can bring $5,000. $10,000. I think it is good for us to make the analysis, but practically, what is even the cost of rent? What is even the cost of getting some capital goods to set up your office? So practically, we are not going to see the worst happening where we will see that $10,000 and $5,000 and $2,000 will be coming into the country and those kind of things. So I think we should look at it in the broader light of the whole business environment. We are trying to kickstart the economy. We are trying to get every aspect or every leg of the economy pushing to help us in our growth agenda, the research agenda, and in the 24-hour economy. And also, I must say that we are also saying that this is a bill which will still be open for all the processes a bill goes through Parliament, which includes public engagement. So the public will also have the opportunity to input into the final text of this bill. Thank you.
Okay. All right. Let's bring in Guta at this point. Government has spoken, and you are the local landlords. Are you happy with this new directive?
So, one thing that we have to make clear is that we do not have to remove the minimum capital before investors come. Investors look at more productive areas and then they drift towards two. When we were showing your data, you recognize that 2013 was the year that we enhanced on the old investment law. We increased the capital requirement. But that was the year that saw the highest number of foreign direct entries into the country. And so what does this show? It means that if your economy is ripe enough and a necessary environment is created, that alone will bring in these investors. Because when it comes to trading, we have made it clear, and we know that the president did not travel to Japan to solicit for traders to come in and do the trading. So we know that maybe he's thinking about the other areas of investment apart from trading. Trading is a no-go area, and we know that. Because for now, we have been overtaken by foreigners. We don't owe this economy at all. As we are speaking, banking is gone, communication is gone, trading is gone, insurance is gone, oil and gas is gone, even mining is gone to the foreigner. What is left? But there is everything necessary for us to protect the domestic industries. It is very important. It is allowed, even in the continental free trade area, it is allowed that we protect we give about 10% protection to member countries. The trade wars that is going on in America, the tariffs and all that, are all geared towards protectionism. And so it is, okay, let me give you one typical example. When I was growing up, the printing press industry was booming. Anybody can set up, they have the capacity, they have the know-how and all that. And now where is it? It is collapsed because the Chinese have taken it all. We are competing against bigger companies. We are competing with companies that are coming with cheap capitals, cost of capitals and all that. There's no this law of what do you call a competition law? There's no competition law here, so we leave it open-ended, and then the locals suffer the fate of it.
Okay.
So in any case, the president have not shown us the areas that we need or seek these investments that he's talking about. But now we should know the areas that we clearly need this investment and the areas that we think that the locals have the capacity to do, or where they are encouraged they can do better. These are the things that we have to be talking about, rather than removing the limit or the capital requirement and all that. That alone. Have you not even been there? Where we have said that we have 5 billion foreign direct investment. And what did we have to show? They would say that 5 billion foreign direct investment have come to Ghana, and you go through the whole of Ghana, and you will not see any significant infrastructure to show the proof thereof. There are abuses in this investment. Sometimes, if you make it that easy, if you make it that free, all that it means is that they will come in and divert to other areas that you do not even require them to be, like trading and all that. Even in the past, they will come in the guise that they are manufacturers, and then they get the investment loans.
To retail.
Then they veer to retail. So the president should sit down again and then reflect upon the areas that maybe it is so needed. I think we are thinking about driving investment. The investment laws should drive investment to more preferable areas of the economy, like high technological areas, mechanized farming, and then IT, and then this new fintech. And these are the areas that the locals, and even that, the other countries that want to succeed, they make it compulsory for the locals to partner these investors.
You're talking about joint venture.
A joint venture, it make it a compulsory so that we will learn under their expertise. But if you give them the opportunity to come without these conditions and all that, it will not serve your interest, because it does not also mean that when you have more foreign direct investors, then it's going to help your economy. Sometimes it destroys your economy.
Okay.
Because we don't have the retention policies here, where people can repatriate their profits and all that. Sometimes they overprice their capital just because they want to export more of the forest. They will overprice their capital without us not doing the necessary due diligences on these companies and all that. Their business alone. And so we have to be careful. But the president have every right and the zeal to seek for investors. But we should know the areas that we are seeking these investors, and then at the same time, how we will protect the indigents so that we can also grow up our business.
Great. Well, I'll come back to you on other points. I mean, let's bring in Cat Africa, Mr. Adumako. You have been doing some write-up, not just, I mean, you started way back 2019. You've been writing about this minimum capital requirement. And what I find in your write-up is the barriers, the restrictions that they bring in terms of foreign direct investment and even wooing other foreign investors to come into the local economy. I mean, looking at the barriers on one side, how about the fear of foreign dominance? And what more do we know about your article and what you've been writing about the foreign direct investment and minimum capital requirement that investors need?
Okay, thank you very much. Back in 2019, we did a work which was funded by the World Economic Forum in collaboration with the GIPC. And one of the key things that we saw from the work was that we realized that the minimum capital requirement that time, which we still have it, serves as an entry barrier to some businesses that want to come into the economy. There are some sectors whereby people don't need 1 million cedis as a minimum capital. There are some sectors that people need less than, let's say, $200,000 or $100,000 to do. And those sectors, because we have artificially set the thing high, that barrier tends to prevent people from coming into those sectors. And so instead of having a blanket limit, we recommended that we need to do a landscape study of the sectors and look at the sectors where minimum capital can be kept high and where it can be kept low, so that we can attract investors into those sectors. And when the market of those sectors becomes saturated, then we can also up it to serve as an entry barrier. And that recommendation was brought in by GIPC, and I'm sure that possibly also informed this kind of discussion. And I'm happy that the president talked about it, because, as a country, we need to grow. We need foreign direct investment. And so the president is under, the World Bank also has been on Ghana government to also amend the GIPC Act as a way to attract foreign investment. But as a country, we also need to be able to know what are the potential ramifications of kind of removing the entry barriers and allowing everybody in. You see, everywhere you go, no country allows, every country you go, there's a visa requirement. For example, US has a visa-free for Europeans, but not visa-free for Africans. There's a reason for that. Because the markets of those two, the economies of those two are not the same. If US were to allow for visa-free for Africans, I'm sure that in a matter of 2 months, the whole America will be populated by Africans. And so by putting up a visa requirement, you're able to exclude some and include others. And so it's very important that we consider a surgical approach into minimum capital requirement instead of coming to have blanket approach.
I mean, but when you say a surgical approach, what then do you mean? What are the specific? What should we do right? I mean, should we go with the scrapping of all the 3 requirements? Should we maintain the joint venture side? Should we take away the 200,000 minimum capital requirement, or your focus is on the $1 million requirement in terms of those who are coming into trading?
Okay, you see, I'm not a physician, but when a doctor is doing a surgery, they take every patient and the way the doctor will want to. So step by step you kind of what at the individual level. So surgical approach to this this minimum capital requirement requires that looking at every sector separate from the other. So for example, you take the mining sector, and whatever thing that you are doing must also be informed by evidence. Do we need to attract more investors into investment into the mining sector? Okay, then we can reduce the limit. But if you reduce the limit, is it going to bring people who will come from Asia and come and do illegal mining? If so, then you want to what? Increase the requirement so that those people with higher capital will come and do the proper mining. Let's say you want to do the ride hailing. Now we have 3 companies, Yango, Bolt, and the Uber. And when they were even coming, they didn't even bring any physical assets except their intellectual properties because they don't even own the cars. But we need all these things to grow the economy. So you cannot set $1 million limit for Uber. Do you get it? Or Yango or Bolt. But there are some sectors that you may want to set a limit higher. And so every sector and its peculiar needs. And so you must be able to do a study and identify where we fall short, that you can let the lower bring it down. But where we have more Ghanaians there, then you want to keep it in a way that, because there's also one thing about foreign direct investment. It's good, but if you don't manage it well, at the end of the day, all the profit that will be made will also be repatriated. And then it put pressure on your city, and the city starts to depreciate. And so as a country also, we also need to be able to encourage domestic ownership of the economy. If all your industries are owned by foreigners, when you go to the industrial area, if you go to the sprint, it's almost foreigners. And we are making Ghanaians become workers and laborers, and they are not consumers and not being treated well. And so whilst we want to attract foreign direct investment, we must also find ways and means to even empower indigenous
local participation
in the economy. Of course, I believe that the $1 million is too high. The $200,000 for some sector is also high. But if you want to remove it, we need to consider every sector based upon the needs base and then lower it. And where some, you maybe have to take it even $2 million. For example, if somebody wants to come and open, let's say, a TV station in Ghana, we have so many TV stations. If you don't take care, foreigners will come and then they will come and take over the media landscape. You know, in Ghana, we wanted to clean up the banking sector. We ended up, and now all the indigenous banks went under the drain. Now the banks we have are the Nigerians and South African banks. So we must also be thinking about what are the impact assessment of these. So it's not just about the policy, but we must also do what? The regulatory impact assessment of if we were to lower it, what will happen? And I'm sure that people in Ghana can do this work and submit it to Parliament, and that will inform the way forward on this particular matter.
All right. I'll come back to you. Yeah.
Read something
small. Okay, that's fine.
The $1 million is for trading.
Trading
is a presence of Ghanaians. That one is stated.
Locals, right?
So what I presume the president was talking about were other areas of investment outside trading. And that one, the maximum capital requirement is 500,000. And then 200,000 for joint ventureship. So I want to clear. So the 1 million, even we are insisting that it goes to 2 million. And then
so that you'll be protected.
Exactly.
Okay. Let me bring in AGR at this moment. So therefore, I mean, you have heard this news. How did you receive it? Is it a good call from the president?
Yeah, good evening, Isaac, and good evening to your listeners. Can you hear me?
Loud and clear.
Very well. Well, my initial reaction was unpleasant. And the reason I didn't feel happy about it was that the GIPC Act Act 865, was structured such that it will protect the vulnerable aspects of our economy. The areas that, or sectors that were receiving the protection were clearly outlined: retail business, taxi services, etc. Now, the risk in removing this cap, trading still has the 1 million cap when I looked at the proposed amendment.
Yeah.
The risk we have, opening up the economy generally to foreign investors, primarily is my concern about the cost of capital. In Ghana, if you are the indigenous business, you want to borrow from the banks, even with the depressed cost of credit, you'll be paying something north of 20%. Foreign investors have access to funds
2%.
from anything between 4% to 6%. So if they bring these funds in, and there are two laws that regulate the inflow of forex. One is the GIPC Act, and the other one is the Bank of Ghana Exchange Control Act, Act 723. At the moment, anybody can bring any amount of money into the country as an investor under the Bank of Ghana Act. You only have to declare it. And they also allow you to repatriate the funds, including your profits and dividends.
Exactly.
The GIPC Act specifically tries to protect certain aspects of our industries. Now, if you lift that veil and allow everybody to come in, it will crowd out our indigenous businesses who are struggling to grow. What we need to do is to find a way of supporting these industries with capital that we have in Ghana. The pension funds are sitting on 86 billion Ghana cedis, which amounts to $7.9 billion at today's rates. What are we doing with that money in our economy? We are sitting and loaning the money to government. It is not going into the productive sectors, and we are struggling to sustain even the achievements we've gained from monetary actions in our economy. Let us refocus. It is not capital that we do not have. The capital is there. We are not applying it to the appropriate areas that we need to invest in. I'll go to these pension funds. I'm particularly concerned about the pension funds because when you go to the developed countries, they drive their economies. These are long-term patient capital that they invest into the productive areas. In Ghana, the National Pension Regulatory Authority amended its regulations to allow pension funds to invest up to 25% of their funds in alternative investments other than treasury bills and government bonds. In 2024, only 0.58%, that is less than 1% of those funds, were invested in alternative areas. Why are SMEs struggling? Why can't they invest there? They say those SMEs are risky. Government should find a way of de-risking. One of the risks is the cost of capital. Anything you produce, if you have to borrow from the bank to operate with, you are disadvantaged comparative to any foreign investor that is coming in. Across the economy, look, if you go into the bank's books, most of Ghanaian enterprises that have even scaled up to compete with the foreign investors, they are struggling. I align completely with Mr. Obeng when he said that one thing we don't focus on is transfer pricing. Because of the structure of foreign investment in our books, when they are coming in, they are bringing equipment, they are bringing goods. There's a tendency for them to inflate
They overprice
the money back. They repatriate it with profits. Where does the Ghanaian business, indigenous business, get that opportunity? We sit and struggle with all the challenges. Now we are removing the limitations completely. So if I'm a Ghanaian trader and I want to I raise capital of $10,000, which is about, let me say about 110,000 Ghana cedis, and I borrowed that money from the bank, and I'm paying 25% interest on that money. A foreign investor brings the same amount of money, coming to do the same business that I'm doing, and he's brought the money at 3% or 4% or let's say even 6%. How am I going to compete with him? I'll be crowded out.
Exactly. I mean, on that point of crowding, let me bring in Professor Patrick Esumin. Prof, I mean, the big conversation now is on crowding out, and local investors or local firms are now concerned about the probability of they being crowded out, because you look at the cost of capital, look at the Ghana reference rate at the moment, the average lending rate all about 20%, or currently in the regions around 20%. Inflation is still around 12%. You still have the exchange rate is now inching towards 11 cedis to the dollar. Would you say that this is also a good call? The government is saying that the economy has improved. And I mean, but the big fear now is if you allow foreigners to come in and you remove this minimum capital requirement, we could be crowded out.
Good evening, and good evening to viewers and also to my co-panelists. I think in the main, I share with the opinions that have been shared by Guta and AGI. And, you know, I think it will really be a travesty if we went ahead to completely scrap the minimum capital requirements that are contained in investment laws. They were there for a reason. And you have to, so generally the countries that benefit the most from FDI are the countries that make strategic choices. So you look at your economy and you have a long-term strategic plan and vision. Then you figure out areas where you feel foreign participation will be helpful. And even that is generally temporary because you have a strategy. And you say, okay, maybe this area, I don't have enough expertise, I don't have enough capital. So in that area, for maybe the next 10 years, I want to encourage foreign participation in that space. And then you do that so that you ensure that they are there to fix or to fit into a particular long-term strategy that you have. So if that's your approach, you will never go and say, oh, I'm going to open the way for anyone to come in. And I think I'm particularly worried about the issue with, particularly to do with trading, the investment in trading, because there's a reason why the minimum capital requirement for those in coming into trading is double what you have for other sectors. I mean, if it was me alone, I wouldn't even allow trading, foreigners to come and get involved in trading at all. Because trading, when you allow foreigners to participate in trading, that's one of the easiest way of increasing your import bill. Especially for an economy that has challenges with production capacity. If you are not producing and you are saying foreigners to come and engage in trading, what are they going to do? They are simply going to import from their country to come and trade. So I think the measures that were there, it has been there for a reason. And if you trace back the history of our investment laws, going back all the way to 1981, 1985, 1994, we have gradually been easing the conditions for foreigners to come and do business in Ghana. I'm not in any way against foreign participation. I just think that we have to be a little bit more strategic about what we want them to do. What is our long-term plan? And where do these foreign firms fit in and where? And in any case, you can't even say, oh, I will allow foreigners forever in any sector. Because if you have a long-term plan, even if today you're not good at petrochemicals, you have a long-term strategy to develop that. And also know that the sectors where the previous act foresaw that we need foreign help, the capital requirement don't apply. If you take the current act as we have it, a sector like export trading, it doesn't have any minimum capital requirement. Why? Because that's an area where foreigners can be really helpful because it's very difficult to enter foreign markets to export. So those areas, foreigners who already have their networks and their contacts, when you allow them in those spaces, then it's much easier for them to use their network to help. So I think we completely have to move away from that. Okay. I think in addition to the suggestion, the legitimate issue that have been raised about disadvantaging Ghanaian producers who, as you've enumerated, they face extremely hard conditions compared with those who are coming from elsewhere. So to give them another helping hand, I think is to really be a travesty.
Well, Mr. Obed, I mean, let's look at the whole thing from this angle. 2022, when we had that massive, economic crisis, it was the locals that held the fort. Foreigners, a lot of them went and left. I mean, they left, and you had to hold the fort, right? And now that the economy is getting back, inflation is coming down, exchange rate has improved, it's your time to possibly enjoy, and you are hearing this news. I mean, do you feel betrayed at the moment?
Oh, no, not yet. Unless we know the intentions of the president, and then he give us a clear
plan.
A plan. The reason why he said that, but we also believe that he understands, because we are talking about import substitution, and then being self-sufficient and all that. And all of this, we want the indigents to do that, so that in times of crisis, like you mentioned, we'll be able to sustain ourselves without depending on any foreigner. So it's very important that this thing that we are discussing, we put it in a proper context and without emotions, and then understand that we will be better served if we do everything to empower the locals to attain the higher levels in the economy. It's very important. Now it has been taken away from us. So it is important that we sit down and then revise the investment law so that we can also have the capacity, the same way the incentives, capacity tax exemptions, and all that, the same way the foreigners get, and then also make conscious efforts or deliberate effort to support people into more productive areas and all that, especially with the food production and all that, so that the question that you ask, we can be self-sufficient when the times...
Okay. Well, Mr. I mean, thankfully, Guta is not disappointed yet, but you have a bigger framework called the 24-hour economy. How does this fit in?
Yes, quickly, I must say that, I mean, there's one theme that runs into other submissions which have been made. It's that the Ghanaian business or businesses in Ghana will thrive, and especially local businesses. And trust me, we as a government are very much committed in ensuring that Ghanaian businesses thrive, and nothing will be done that will sort of jeopardize that particular motive or that particular aim. With regards to the 24-hour economy and the accelerated export development, I mean, this fits right into it. If we are trying to, you see, a special session or a special wing of the 24-hour economy is the Volta Economic Corridor, where we're going to use the Volta River and the Volta Enclave as a driver of economic growth and water transportation, with a lot of exports industry for agriculture and agro-processing and those kind of things. So it fits right in that we sort of improve the environment now, send the right signals to the international community so that they can come and partake in our economy. I must add that in addition to all this, all local we have local content regulation and laws. They still apply. Okay, they still apply in the petroleum sector, in other sectors. All our local content regulations still apply. So everything will be done to protect the interests of Ghanaian businesses. Okay. Thank you.
I mean, Frederick, let's look at this way, Mr. Edumako. I was looking at the GIPC Act, and I saw that amidst all the restrictions and the requirement, if you're a foreigner and you're able to move into the Ghanaian space, marry a Ghanaian, for a period of 5 years continuously, you are able to actually do away with all of these requirements. So, in fact, are these requirements or these leeways not enough for us to still hold the minimum capital requirement that we have? Because somebody can just walk in, marry a Ghanaian for a period of 5 years, and has every legal right to enjoy or do business in Ghana without these restrictions.
Yes, yes. Legally, when you go to some countries and you have a resident permit and you live there for some years, you are even moved from resident permit to a permanent residence. Even you can even apply for a citizenship. And so I think that that provision, it is also a best practice everywhere. So after that, you can actually you'll be seen as a Ghanaian, and that restriction will not. But that 5 years must be continuous.
Yes.
Not just you are married to a Ghanaian in America, then you come and live, you come to Ghana every 6 months and go. You may not be able to clench on that particular provision in the Act. And so, however, if you are not a Ghanaian and you come, you need to comply with that. And you need to also be able to provide evidence. Of course, GIPC can go to Ghana Immigration Service and get all your arrival and your departure records to see whether you qualify or you do not qualify. You can't just walk to GIPC and claim that, look, I married Akosu Amansa, and we married for about 6 years, so I qualify to come and start with 20,000 cedis to do a job at Kaneshi. No.
The fear is on the retail side, the trading side, where currently we've all seen the protests that went on, especially with Nigerians trying to take over the retail aspect and all of that. In fact, we also live in West Africa, where we are supposed to allow a free flow of goods and capital. So we already have a layer, a burden that we are dealing with in terms of those coming in from West Africa. Well, aren't we going to hurt ourselves if we decide to, open the floodwaters for foreign investors to come in without capital or requirements?
Okay. When you look at the AU, let's start with ECOWAS. ECOWAS laws permit movement of people, movement of capital. However, the ECOWAS law also requires countries to set up their own rules. The same applies to the AFCFTA. AFCFTA did not set up any minimum capital requirement. It has deferred to member states to use their laws to set up, because South Africa may not need a minimum capital requirement at less than $200,000, but Ghana may need it. Nigeria, so every country needs to be seen at what different. So that is why no threshold was set for any country. Because you go to Sudan, let's say a country like South Sudan, it just came out from war, a new country. So their needs may be different from Ghana. So if you put one blanket under the AU level, you will not help anybody. And so now let's come back to ECOWAS and then ECOWAS and Nigerians in the market, which has been a banter between the Nigerian traders and GUTA. For me, as a competition expert, I see that the presence of the Nigerian traders in it provides some form of competition in the market. However, it must be done in consonance with the law. What does the GIPC law says? The law is the law, not what it ought to be. If the law says that if you are non-Ghanaian, Nigerians are non-Ghanaians, and if you are non-Ghanaian, you want to operate in the Ghanaian market, you must meet with the minimum capital requirement. Once you meet it, I'm sure you can open 20 shops. Nobody will fight. Will fight. Will fight you. However, if you go to areas where you go to Okaishi and you have foreigners who do not meet it, then they are going against the law. Do you get what I mean?
Exactly.
Yes.
You're itching to have a bite on
the
issue.
That one is so clear.
Yeah.
So we are in a sub-regional bloc, either ECOWAS or the Continental Free Trade Area. All is good. And then they've set the rules and regulations that we should all abide in it, whether you have your local investment laws or not. But what are the rules telling us? It's telling us the ECOWAS protocol and then the Continental Free Trade Area say that we should do a business among ourselves without any hindrances at all, that there should be free movement of goods and services. But the underlying principle is what? the rules of origin. That the business that we are doing, the trading that we are doing, should be the goods that are manufactured in our respective member countries. That's all. That's where it ends. And so we have these rules, and then GIPC can factor this rules and regulation into the GIPC Act, and then demand that those neighboring countries, the foreigners from neighboring countries, have every right to trade in the goods that are manufactured in their country. And Ghana has breached no law. But the law in Ghana is saying that if you are bringing goods outside the goods that are manufactured in Africa, the member countries and all that, and you are bringing the goods from China, Turkey, Dubai and all that, then of course you have to abide by our investment laws. It's as simple as that. And that you still have to, because in the economy we don't want to be import oriented. That's why economists will say that we import too much. And normally they seem to target the locals. It's very unfortunate that we import and import even too big. And that's what is destroying our economy. Forgetting that the local share in this importation is less than 20%.
Are you threatened by Nigerian traders?
No, we are not threatened by them. So far as they abide by the rules. The rules, the ECOWAS protocol says that they should trade in the goods that are manufactured in their respective countries. That, in this case, in Nigeria.
Are they doing so now?
They are not doing that. And that made them unqualified. Because unless they follow the investment law and abide by it, we are not going to allow them to import the goods from Thailand, China, and all that. That's what our investment law is talking about, that in that case, you have to register. But for them to trade in Dangote cement and all that, that is within the context of the Continental Free Trade Area, the ECOWAS protocol. That's it. And once they are not doing that, we are not going to allow them to abuse the laws of the country. Let me tell you, what importation is worrying this country, and that's the share of these foreigners that we are talking about. Now, all that a foreigner needs is to bring in $1 million of goods. Initially, we wanted them to bring the cash and deposit it at the bank. But GIPC itself said that they should bring the goods either in cash or in kind. So they bring the goods. And presto, they are there, they have qualified. They have to also employ 20 skilled labor before they can. That's the requirement. Before they can do the trading. Now, look where the problem is. The problem is where they are not even demanding that they bring their matching capital, the capital for import. What they do is that when they qualify, the floodgates are opened for them to bring in the goods without any matching forest and all that. They bring in the goods and then they sell and then repatriate.
Who is expected to check this?
The Bank of Ghana need to check, because why is it that they don't bring in the correspondent fund for trading? They bring only the goods and then
requirement for employing skilled
labor. And they only bring the goods from, because they are manufacturers' representatives. This China malls, this China town and all that, they bring thousands upon thousands of containers. And we are saying that we should also, as part of the investment law, ask them to bring the forest, the correspondent fund of the import into the local banks before they can, as a buffer, before they can use it to import these goods. That's why the economy is suffering. So other people are also going to for cheaper credits from HSBC, these big banks for 2%, 3%. And then they use the money do not come to Ghana. They buy the goods, China, India, and elsewhere, and then the money is used to serve these countries. And then the goods come to Ghana. And then the maturity date for payment, when it is due, they depend on our local forests. Are we not destroying our country? We are destroying it. So we only have to use the investment laws to contain them. And we are not using it, and we say that we have to relax it, and then come and say that we import too much and all that, and we don't know that this is the problem. So if you do not do all these things, we are destroying our economy. So the limited forest that we have, these people will feed upon it. And when, especially in China, when they succeed in bringing their China malls, China towns and all that, then they start restricting visa requirement, visa for people to access visa, the locals. That's what they've used to succeed everywhere, where they have, it's a state policy. That when their people come here in their numbers, then they have to restrict the locals. All these things we don't see through. And then they are taking it all. Now they've taken about over 60% the market share. They open shops up to even on Sundays. And what is left for us on Mondays? Nothing is left for us. And they keep on opening big companies without bringing the correspondent fund. They only bring the goods and then change the forest and send it to their home countries. And we think we are doing ourselves any good. Let's think again.
Well, I mean, Mr. Defo, I mean, let's think again is the core. And the focus now is on foreigners who are coming in to do illegal business. We've spoken about the Nigerian angle and then also the Chinese retailers. What's your biggest fear at the moment? I mean, with this new law, are we likely to see this, being worse when the law is relaxed and the minimum capital requirement possibly is no more?
I mean, if you analyze all the contributions of the panelists, everybody has a concern. But I'd like to give some advice to GIPC. If you read the memorandum accompanying the amendment bill, you'll find out that GIPC thinks that most of the existing clauses or the protectionist clauses in the Act have been defeated by other laws and therefore has rendered them ineffective. That is why they want to amend to remove them. A typical example is what I tried to explain with the Exchange Control Act. It doesn't give you any limit as to how much money you can bring in. So you can bring the money in, declare it at the port, fill the exchange control forms, and then when you come in and you decide to do business, for example, you go to invest on the stock market, you don't need any further approvals from GIPC to do so. But in time, they may take their money out, buy a local business, go into some trading activity, and bypass the GIPC Act. What rather GIPC should be seeking to do is to get those laws rather to align with its act, not to amend its act to free those protections that it was giving to Ghanaian businesses. And really, what are we talking about? When I looked at your data, the graph you brought about foreign direct investment coming in, the 2 years where you had the highest, they were because of investments in petroleum production. 2012, we discovered oil 2011 December. 2012, the Tallow and Co brought in a lot of money to set up the industry. 2017, we had a few more oil wells coming on stream. There were investments there. So it is not into the general economy per se. It's
specific areas, right?
Yes. So Professor Assuming made a comment about us prioritizing where we want investments to go. The government has talked about the accelerated export transformation agenda. Which products is it focusing on exporting? It can then open the door and say that I want to export processed cocoa, I want to export refined gold, I want to export processed oil, whatever. When you come up with them, then opening up creates an incentive for foreign investors to come into those specific areas. Don't open the door ajar and say anybody with any amount can come in and do whatever they want to do. I talked about the cost of capital. It disadvantages us. So if it disadvantages us, who is going to be there to protect Ghanaian businesses? What do we do? It's the intention of opening the door for capital to come in may be a good one, but the outcomes we'll arrive at if we open the door ajar will be very negative for our economy.
Okay.
Let's support our local industries to produce locally so that the traders can distribute what we produce. We should stop focusing on the low-hanging fruits of getting easy revenue from the ports from imports. So open the floodgates for more imports to come in. Please, the production is the only way we can sustain our economy. When we are talking of structural changes, the structural changes is that we should focus more on processing our raw materials, producing in Ghana, and moving away from importation.
Okay.
Opening the floodgates for FDIs to come in, where the law says you can bring goods or cash. Like Dr. Abin was saying, you're going to be bringing in goods and taking out cash. Bringing in goods, making profit, taking both the profit and the capital away.
Well, Prof, I mean, you have listened to all the conversation, and the general analogy that we are getting here is that if you allow the foreigners to come in, you definitely are going to crowd out the local firms. But per where you sit, what is the burden ahead? Definitely there's a call from the president, and I'm sure he has done his own analysis, he's checked the data, he knows what he's saying. But from your side, what could be the burden ahead for Ghana, a country that is recovering from such an economic shock in 2022?
Well, I think the economic shock is a great place to start, because for me, the biggest thing we should have learned from that shock is that you can't continue with the kind of financing model that we have had, especially in the last 30 years or so, where we think that foreign funds is the only way to develop our economy. It just, so when we have this kind of thinking, it just tells me that perhaps we haven't learned the right lessons from the crisis that we went through in the last in 2022 coming up. Because when and if we put that together with the COVID, one of the things that we should have learned is that when it comes to the crunch, you can't rely on other countries for the most critical things. We saw with what happened during the COVID vaccines. We've seen in recent times, everybody is fighting for themselves. So I think we have to change, our thinking that, the only way we can develop our economy is to rely on foreign financing. And that it cuts across, and I'm glad that Eric had mentioned at some point, we have to look at everything in totality. It's not just foreign direct investment, but also even at the moment, it appears that we think that the euro, going to the Eurobond was the biggest problem, and that, if you are not going there, everything else is great. But don't forget that the cyclicality we see in our exchange rate is because of our overdependence on foreign financing, including FDI, where at the end of every first quarter, when people have to repatriate their profits, there's massive pressure on the currency. We need to connect all of these and say, okay, yes, at this point, maybe we are not at a point where we can say we are going to depend solely or primarily on domestic financing. But we will say we have a long-term plan to ensure that this way of financing is not going to help, it's not going to work. And that gradually, we are going to wean ourselves of foreign financing, however it takes. So I think if we have that paradigm shift in our mentality, then we won't pass investment laws that disadvantage domestic producers. And we won't pass laws that works against other objectives that we want to achieve. If we want to do restructuring of the domestic or do structural transformation, then you have to make sure that your foreign exchange laws are not giving the incentive for cheap imports. If you want to do that, then if you think that domestic businesses, if you want to have a bigger control over some of the key sectors of the economy, which I think is a good thing to do, then you will not pass investment laws that says, everyone can come in and do whatever business they want to do.
Okay. I mean, Prof, thank you very much. Mr. Obin, I mean, the economy is so big, but what aspects should government reserve for you?
Well, our natural progression.
And unfortunately, that will be your final comment as we wrap up, so that I mean, we are within time, yeah.
Okay. So we are traders. We are first traders. And it's very important to note that the distributive arm of the economy is as important as even the manufacturing and all that, because manufacturing is not complete unless it reaches the final. So the vibrant distributive sector helps the manufacturing companies to grow. So it's very important that we protect the locals who do the bulk of this trading. And our normal migration is from trading into manufacturing. Don't forget about 80% of manufacturers migrated from trading, because you have to trade the goods, you have to buy and sell and know the quality, the type of goods that sells more and all that before you can go and then manufacture. Any person outside trading who have ventured manufacturing has failed. So it's a natural progression. That's why most of us are taking advantage of the 24-hour economy to transform ourselves into manufacturers, so that, like people say, think we are a nuisance to the economy. We are not. That we also get the resources from trading and then also move on to manufacturing that serves the generality of the Ghanaian economy, giving employment and all that. So the whole Ghanaian economy is open to the traders as well as the foreign investors. If we are given the right opportunities, we can also invest the same way they do to help the cause of the nation.
I mean, Mr. Adomako, I mean, definitely government wants to raise more taxes through either income tax or corporate tax. They want to use it as an opportunity to employ more people. But per what we've all analyzed here, what do you think should be the reserve kick for local firms?
Okay, before I go to your question, I would like to say that, I mean, FDI is good. It is like a knife. Depending upon where you hold a knife, if you hold it at the blade side, it can sever you. But if you hold it at the handle side, you can use it to serve your needs and your purpose. FDI is good for Ghana. It depends upon how you use it. And for me, if government wants to open it up, we need to be very follow a due process to make sure that we don't end up creating more problems that we intend to solve. Number two, I also want to say that if foreigners want to go to other parts of the country, northern parts where job creation is zero, and they want to go into manufacturing and production, and if people are coming there with 1 cent, let's take them there, so that they are going there to help develop those parts.
Take them to the northern aspect of the country.
Yes, and other underserved parts of the country. But you don't want to bring people to come down to the south here and come and compete with existing businesses. So we need to have a broader discussion. I'm happy when the president comes, GIPC, in fact, this bill, I'm sure will go through a lot of work. It will go through a lot of work before it passes. I'm not sure it will be passed under a certificate of urgency, because this particular provision is very, very important for people of Ghana.
Mr. Adefo, under 30 seconds, what do you think should be reserved for local firms?
The data is telling us that about 85% of our economy is SME business. So as part of the restructuring of our economy, we need to bring that figure down and scale up SMEs to go up to larger production.
Okay.
Now, the bill may have had good intentions, but from the analysis, I think that the government should slow down. We need to be deliberate in our actions. And in that, whatever we think that we need the FDIs for, we should be specific. Opening up the door for anybody who has a penny or a dime to come in and engage in economic activity is not the way to go.
Okay.
Look at our economic structure. Let us see where we have some competitive advantages. And if we are lacking capital, then ask FDIs to come in specific sectors
All right.
For now, I believe that locally we even have enough capital. It is just that we are not pushing it into the right areas. And therefore we are struggling with building our
well,
production.
gentlemen, unfortunately, this is where time will allow us peg our conversation. This has been PM Express with me, Isaac Kofi Ajay. This is Joy News, independent, fearless, and credible.